Welcome to Windfall Edutech Advanced Module. Chapter 4. Derivative Strategies. What is mutual funds (MF)? Types of mutual funds. Exchange-traded funds. Why to invest in mutual fund. Tips for investing in MF. What are mutual funds? They are investment vehicles, which pool together all the money from investors and invest in different asset classes such as equity, fixed income, etc. Nowadays everybody wants to invest in capital market in order to attain higher returns. Mutual funds invest in capital markets on behalf of investors. Since the time mutual funds have come in, they have caught the fancy of investors in a big way. Types of mutual funds. On the basis of structure, mutual funds are divided into open-ended and closed-ended funds. In case of open-ended funds, investors can buy and redeem the units from the mutual fund itself at all time. In case of closed-ended funds, investors can buy and sell the units on the stock exchange. Types of mutual funds. Sector funds, diversified equity fund, bond funds, index fund, money market funds, balanced fund, ETF, exchange-traded fund, FOF, fund of funds. Sector funds. In this fund managers invest all the funds they have in one particular sector. Sector funds are considered to be the riskiest of all. This is because, making the investment in one particular sector does not give any scope for risk diversification. Diversified equity fund. Considered to be less risky than sector fund and favorite of investors. In case of diversified equity fund, all the funds are invested across various sectors and thus help in negating the risk that exists in sector funds. Bond funds. Bond funds invest in the fixed income securities such as government bonds, corporate bonds and junk bonds. Bond funds are less risky as compared to equity funds. Being less risky, bond funds offer less returns as compared to equity funds. Index fund. Index fund replicates the index in the exact same manner. Fewer expenses as compared to other mutual funds because it mirrors the benchmark index. No fund management charges and relatively lower trading expenses. Money market funds. Money market funds invest in the short-term money market securities such as treasury bills, repos, certificate of deposit, etc. Many corporates and institutions invest in money market instruments as they are fairly liquid. Balanced fund. Balanced fund has combination of equity as well as debt. An investor who has a medium risk appetite can invest in a balanced fund as they are considered to be less risky as compared to equity diversified fund. ETF, exchange traded fund. ETF has combined characteristics of both mutual funds and the closed-ended funds. ETFs trade at stock exchange at the prices that is approximately close to the ETF's NAV. FOF, fund of funds. FOFs are the funds that invest in other funds. FOFs charge a very nominal fee as they do not need much expertise or incur expenses while investing in other funds. ETF funds, the complex new entrant in mutual fund family. Exchange-traded funds, just like closed-ended funds and stocks, are actively traded on the stock exchange. It can be termed as a combination of mutual fund and closed-ended fund as it combines the tradability feature of closed-ended funds with the valuation principle of a mutual fund. That is, in a mutual fund, valuation of mutual fund portfolio is done every day on the basis of changing market prices of the stock, which causes a change in NAV of the fund. Whereas, a closed-ended fund is traded in the stock exchange. Most ETFs tracks index such as S&P 500, Sensex, Nifty, MSCI EAFE, etc. How does the ETF operate? In case of ETF, asset management company appoints authorized participants. These participants give all the shares that form part of the index to the AMC. In the exchange of the shares, AMC gives them the creation units. These creation units are major chunk and hence are divided into small units which are bought and sold in the stock market by the apps. In case of more demand for the ETF units, these authorized participants need to deposit more shares with the AMCs and get more creation units. However, in case of redemption, the apps returns the units and get their shares back from the AMC. Apps in turn sell these shares in the stock market and make the payment to the investor. Since the time the ETFs came into existence, they were passively traded, but recently even actively traded ETFs have come into picture. A passively managed fund is the fund which mimics the stock index. Passive management means that a fund manager can make minor changes to the portfolio to keep it in tandem with the chosen index. In case of active management fund, the fund manager manages the fund and tries to outperform its benchmark index. Passively managed fund is cheap as compared to an actively managed fund due to its almost negligible fund management and trading charges. Why should you invest in MFs? No time or market knowledge. Equity markets are volatile and investment in it requires lot of time and effort on the part of investors. Also, one needs to study the companies in detail before investing. Most of the retail investors either do not have the time or the expertise for this. Mutual funds are managed by fund manager who are experts in their field, so be rest assured that your investments are taken care of by the professionals. Diversification. Diversification ensures reduction of risk. A mutual fund invests all their funds across various securities, thereby reducing the risk in the portfolio. Any layman will not have the required expertise to invest across various companies, thus diversification ensures spreading your investment across various companies. Fund manager. Mutual funds are managed by fund managers who are experts in their fields. They will take the right decision keeping in mind the theme of the fund. Fund managers provide their services to the fund for a charge called as fund management charge. Various types of mutual funds available. Sector funds, diversified equity funds, ELSS, fixed income funds, balanced funds, liquid funds, ETFs, etc. Thus mutual funds give lot of choice to investors who can invest in funds on the basis of their risk-taking ability. Plethora of funds and schemes. There are loads of mutual funds offering loads of schemes and thus offering wide variety to investors. Investors can choose from the vast plethora of funds and schemes available. Thus investment in mutual fund gives lot of choice to investors, something which they would not have got by investing on their own. Tips for investing in MFs. Align your investment in accordance with your goal and risk appetite. Before investing in a mutual fund, you should know about your goals and the amount of risk you can take to achieve these goals. Equity funds are the riskiest of all, high risk takers. You can invest in diversified equity funds or ELSS for tax-saving purposes, balanced fund, combination of equity and debt. Investors with extremely low risk appetite should opt for pure debt funds or liquid funds. Past performance is not guaranteed in future. All mutual funds have a disclaimer that past performance may not be repeated in future. An investor should not look into the past performance of the funds, as returns in a mutual fund are market-linked. Thus, future performance by no means can be gauged from past returns. Don't fall to NAV trap. NAV by no means is an indicator of firm's performance, but only a measure used in mutual fund accounting. You will come across many agents trying to fool you, by saying to opt for particular fund on account of higher NAV. Don't fall to their trap, as it is just a tactic used by agents to which innocent investors fall prey to. While investing in a diversified equity fund, you have two options, say Fund A and Fund B. Fund A has a NAV of 10 and Fund B has a NAV of 50. Just because Fund A has a NAV of 10, that doesn't mean it is cheap. Irrespective of whichever fund you invest in, your returns would be more or less same. Fees and loads. You should always keep a close eye on the fee structure of the funds. Before selecting a scheme, always select a scheme with the lowest fee structure, as this would enable you to earn higher returns. Although, some investors might feel that fees are small amounts, so much so that in a bull market, it won't make a significant difference to your portfolio. However, if your investment is huge, the amount that would be chucked out as expense might turn out to be quite significant. Diversification. The biggest advantage of mutual funds is that it gives you the benefit of diversification. You can invest in a diversified equity fund or across various funds in order to minimize your risk. Study the fund manager's performance. Performance of a mutual fund is majorly linked to its fund manager. Opt for a scheme whose fund manager has a good track record. Thank you. Revise and get ready for the next